Major funding for these broadcasts has been provided by grants from New York Community Bank, Capital One Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Aerial Property Advisors, Dime Community Bank, Perfect Building Maintenance. Additional funding has been provided by AKA Hotels Corman Communities, AmTrust Title Insurance Company, AVR Realty Company, Avison Young, Bank of America, Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, JP Morgan Chase, Citizens Bank, Cohen Equities, Colliers International NYC, Collins Building Services, Connect One Bank, CPEX Real Estate Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Polsinelli, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Knackle Group at Cushman & Wakefield, the Merinkoff Family Foundation, the Moinian Group, and these friends.
Money, 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 money. That's what you need when you buy real estate. So today I've assembled this group of alternative lenders, these people who provide, plus an attorney, who provide alternative financing. My guests include Josh Zegen, who is the co-founder and managing principal of Madison Realty Capital, Randy Reiff, who is the CEO and the CIO of Allegiant, okay, real estate, John Brayshaw, who is the co-founder and principal at the Prime Group. Our attorney over here, Dan Flanigan, who's the head of the real estate finance group at Polsinelli. And last but not least, Jonathan Chassin, who is the CIO.
Managing Director of Moinian Capital Partners.
You got it. Okay, since you're the new kid on the block, how do you like being in the business of providing alternative money?
It's a very competitive market. You know, everyone has to find their niche in today's market. And I think, you know, transitioning from a traditional investment banking career to alternative lending, you know, gives us a little bit of an advantage in terms of being able to reach.
So why do people go to alternative lenders? Why do they go to Zegen over here, or Randy, or John?
I think the primary thesis for all of us is that banks are pulling back dramatically, and there's a significant amount of capital that's required to fill out capital structures. And I think, you know, without any downturn necessarily being in sight for any specific commercial real estate property types, I think you're seeing just a continued expansion of the market and need for more capital.
In your practice, how many people have you seen become new alternative lenders over the last couple of years?
I'm not sure I can give you a good answer to that question. I know that we've worked on 5 or 6.
Here we have a developer, an owner of real estate who's gone into the financing. Josh has a two-fold business. One is a developer and one is the financing entity. This is in general for everybody to answer. Are we seeing more entrepreneurs become alternative lenders today? Randy?
I mean, I think the catalyst for the crossover, and I do think you're seeing a lot of it, but a lot of that has to do with equity investors struggling to find equity returns. And so I think a lot of that strategy that you're seeing repeated is, I can't get the equity returns I want. I can get reasonable returns from the perspective of an equity investor. We could discuss separately whether debt investors feel the same way in these assets, and I'm prepared to own them. So I don't want to say it's in any way, it's not necessarily a loan-to-own strategy, but it's a loan prepared to own strategy. And I think that's probably what's brought the Moinian Group into the business and a lot of others.
And what's interesting is most have started out as developers and then went into lending. We actually started the opposite way, which was we started out in 2005 as a pure debt investor, and through the downturn started to take over real estate in 2009 and as the markets became illiquid, and then completely became a vertically integrated firm as a result of that, and started having the debt side and the equity side from 2009 on. And it has made us a sharper lender, has made us a sharper, I would say, equity investor as well, having both sides.
Yeah. And from our perspective and from our equities perspective, as Randy mentioned, it's impossible, nearly impossible, to find deals at bases that historically make any sense, and especially given the interest rate environment. You know, there's an inordinate amount of uncertainty with where your exit is, will be.
Do you see more foreign investors going into this space, Josh?
I would say a lot more foreign investors looking at debt-related strategies, and not just foreign. I mean, years ago when I used to go to pension funds and endowments, they didn't know, do we put it in the fixed income bucket? Do we put it in the equity bucket? And today there's a whole, it's a major theme within pensions and endowments that they want to invest in debt-related strategies.
Where do you see the investors coming from?
So in our business, all of our investors are domestic. We don't have any overseas capital. We have met with overseas capital sources a number of times over the years and found that their interests in debt tend to be more idiosyncratic. They're very asset focused, particularly in Asia. They want to see, the actual, large trophy asset assignments to do mezz or financing behind. And we're trying to really run a full-fledged finance business and don't have the opportunity to give our investors a look at the specific assets that we're going to finance before they decide whether to commit or not. So we don't have any of those types of investors in our funds.
But I would say even that is changing, because it is true, like the Koreans, are major investors in mezz in New York and a number of other places, and now they're starting to get more comfortable with fund-related investments. And I think it's just over time, they started out as a direct investor and then are moving towards a fund.
Also on the separate account side, I think that we also have a comprehensive platform of products. But one place where we've begun to find some success is in attracting, if not asset by asset idiosyncratic investment, then strategy by strategy, meaning a separately managed account, foreign investment in a specific strategy might be easier now to attract than it was previously.
What type of returns do you have to give to these investors for them to take this risk of lending? Because some of these investors are, insurance companies who haven't really lent. Some of them are pension funds who really haven't lent money. How do they get comfortable to get into this business, to invest in you?
Well, a lot of it is, track record and many years of track record and just watching. But what's happened is also there's so many different shades and flavors of debt today, and the investor universe is much more sophisticated in that regard. So there's some funds that'll look for an 8 to 10% net return with X amount of leverage. We look for a mid-teen kind of return, more for special situation debt investing, and that's been our focus.
I also think the challenge for investors who want to put capital into real estate strategies is if you look at 1 to 2% economic growth over the last number of years, historically compressed interest rates, historically compressed cap rates, and sort of an 8-year bull market, it's starting to feel very uncomfortable, I think, for a lot of those investors to look at equity strategies and feel comfortable that managers are really going to hit those mid to high teens returns in a way that they were able to, 5, 10 plus years ago. Whereas they look at debt strategies and the projected returns may be a few hundred basis points inside of the equity returns, but with a 30-35% equity cushion to the last dollar of value in the property today. So I think that's why you've seen a lot of capital flows come into the debt side of the market over the last couple of years.
I think it gets back to that discussion of basis too. And one of the interesting things that's occurring in the debt side is if that's the exact reason why people migrate towards debt. And as the debt markets get more competitive, and I think we'd all tell you, even in the specialty finance world, they're extremely competitive, you start to see, you can make a very bad loan on very good real estate and get hurt pretty badly. You can make a very good loan, a well-structured loan on niche real estate and feel a lot more secure depending on your basis. It's not just a matter of cash flow, but a matter of what that last dollar is and what the long-term viability of the asset is. So I think you're seeing, as you see that creep up, as you see leverage creep up, as pricing compresses, there's nothing left to cave on except structure. And I think you start to see more irresponsible lending practices. And when you see that, you start to see debt feel more like dequity. That's where the lines get blurred. And it becomes a tough decision where to be in that capital stack. And I think that's exactly, the same occurrence.
So I heard from John the comment that, we're in a cycle, the 8th year of a cycle. And this is a subject that everybody always says to me, what inning are we? Where are we in the cycle? What is the point? So when there's a shift in the cycle, okay, we don't know when. If we were great crap shooters. So where do you see, is it dangerous to be in the lending business in this world today?
I think that's the same point. I think it depends where you are. I think it's all about risk-adjusted returns. The fundamental thing to remember on a generic loan with a lower yield is that unlike an equity investment where you can be wrong 1 out of 5 times and still do pretty well, you got to be right a lot of loans in a row if you're a low yield lender. If you're a much higher octane lender, you may have a greater tolerance, but you're getting compensated for it. So I think it can be risky now. But
there are different asset classes in real estate. Which asset classes do you like to lend to? And which ones are you scared of to do today? Josh?
Well, transitional assets, construction-related assets is something that we find there's a huge void in today. I think that there's no one, we don't like specialty assets, so we like multi-office, retail, industrial.
No more marinas, or dockyards?
We do a little bit of hotel in the New York metro area, but we really like general liquid markets, places that have high density, major metro areas in general. We stay away from secondary and tertiary markets.
What about the condo market, Randy?
I think it depends where you are. I think the condo market in New York is starting to feel pretty full. I think you're starting to see,
What about the condo market in Miami?
Same idea. I think
Chicago?
Take a look at the number of cranes up and you'll get a good sense as to that. And again, when you start hearing developers talk about how prices are holding but velocity has slowed down, that's just another way of saying prices are under pressure.
On a national scale, where do you see alternative lenders? And I was looking at the last week, Josh was on a panel with me with Blackstone. Blackstone in their mortgage trust, they basically lend only in 5 states.
Right.
Yeah.
Okay. Do you see that? Are there states around the country where you couldn't get an alternative lender?
Well, you can, but there's very few that are truly national lenders, like
We're one of them.
Prime is.
We are as well. We think there's opportunity.
Or what we call market agnostic.
Yep.
We'll lend in almost any market in the country. If we
Really?
like to. Yeah.
If the real estate is right, there's an opportunity.
What about you?
We like, New York, Florida. We haven't done anything in California, but we're hoping to do something, move an office out there. But it's just we've found that in illiquid markets, when things really change, it's a tough, even if you're in for a great basis, it's tough to get rid of some of the real estate if you had to.
In our market, we were talking before about the Hudson yards. We're talking about Lower Manhattan. Plus, we have transitioning neighborhoods in New York City in general. What's your thoughts about those markets? I mean, Ridgewood, Bushwick, East New York.
We, as a lender, certainly Hudson Yards, we have a relatively large development that's in process now there. As a lender, we like the boroughs. We've lent in Brooklyn, just south of Prospect Park. We're looking at Bushwick now. We think those markets, really it's a matter of time, and those are places where you can find things at a reasonable basis compared to mainland Manhattan. And in terms of other markets around the country, we stick to, where we have operational expertise. New York, LA, San Francisco, DC, Miami. That's really our core markets.
We're not afraid of secondary markets. I think his point is well taken that there is opportunities, great real estate. Even we talked earlier about retail. And we're not overly bullish on retail across the board, but you can find infill neighborhood retail centers in almost any market that are going to be there for a long, long time, are going to be solid. You put a appropriately levered, well-structured loan behind it, you feel good about it. I think that the concept of liquidity, which is an important one, relates directly to how patient your capital is.
Yeah.
So both the question of whether you need to find liquidity at all times, and even the question of how you feel about the outer boroughs, Bushwick, et cetera. Over the next 5 to 10 years, it's hard to imagine that any of those are not going to be fine given the proximity of Manhattan. But if you said, I need to find 3-year liquidity and I have to thread that needle, you may be a little more bearish on investigating those
What about
markets.
suburban office? Because that's a market that really hasn't done well over the years. I mean,
In the New York area, we've done a number of deals like that, and that's really picking up in a place like Long Island and Westchester, New Jersey now. I just guess there was not that much new product built, and a lot of that's being repurposed today. So that's a trend that we've seen, and we've lent into some of those scenarios.
In a lot of the deals that we look at, the operations of real estate and the business of real estate are actually fundamentally pretty good. The economy's not growing as fast as everyone would like, but the trend lines are are positive, and you don't have sort of the boom bust excess construction and supply issues that really led to a lot of the crashes in real estate, in previous cycles.
so you're basically saying we're more disciplined today.
Well, I think the discipline's coming from a lot of different
Right.
places.
Over the last 8 years, the leverage wasn't anything near what it was for before.
Right, and that's why the
07.
banks are even safer today because they haven't been that crazy.
So there's no real trigger event that's causing a liquidity event or a push to sell, or that's the one thing that you notice. I mean, there's some deals that are going through restructures here in New York City that we're seeing that sometimes need rescue financing because of maturing loan and they couldn't execute on the business plan. But there's a lot less than a 2009 or 10 where you had a leverage problem.
Yeah, I mean, that was a perfect storm, even in pending correction. And we believe that that things are coming under pressure and that there's some particular value coming into the debt space because you're starting to see some correction. It doesn't feel like it's going to be catastrophic. There's a lot of capital out there, and there's not as much leverage in the system.
Maybe bumping along the top instead of bumping along the bottom.
Yeah, I mean, it's just not going to be this ski slope down, kind of just doesn't feel like there's any reason to believe that.
Yeah, I mean, the banks, certainly in the construction space, CMBS is significantly smaller as well, and construction just continues to get tighter and tighter. So, there seems to be a continued need for additional financing sources, which is where we all fill out the capital structure.
The other thing that's a little different in this cycle, and I'm curious if you guys are experiencing this too, is we don't feel like we're being asked to compete on pushing credit and structure as much as we are on pricing. Like, we actually think the market's been relatively disciplined, not just the private non-bank side of the market, but even CMBS, because we have a CMBS BP buying business as well. And the credit profile of most of the loans that we see in those pools actually is not getting worse and worse in sort of the classic way that you'd see as the cycle wound its course and eventually crashed.
It's interesting, though, that is usually what begat it. It usually goes the other way, right? Because when the pricing gets so tight that people can't afford to put that money out, whether you're a conduit and you can't afford to lend any cheaper based on where securities are trading, or you're a fund and you can't afford, you're not hitting your bogeys, or you're a REIT and you're not hitting, the returns that you need for your dividends. When you get to that point where you've priced yourself out of the market, you start offering structural concessions, and then borrowers start taking them, and that's when you're going to start to see credit break. So, as to your earlier question, where are we? What inning are we in? That's probably a telling point about what's coming soon when pricing gets so low that you can't go any lower.
Yeah.
But proceeds are being pushed.
Same thing.
Yeah,
Structure.
it's proceeds. More of that. Even in our equity business. I mean, the kind of quotes we're getting from some of the lenders out there. There was a deal I bought recently, an industrial deal in Jamaica, Queens, where we thought we'd get 65% of cost. At L425, it ended up at 75% of cost, and even pushing 80 at L360, L370. So it's interesting. It was, what's happening is pricing is coming in, proceeds are pushing out because the same owners are trying to get to the same returns they were, and the funds are also trying to compete. So there's more of that capital. That's at least the New York area. I can't talk to some of the other.
And that's all.
markets.
That's exactly right. That's structure, right? Same as less AM, weaker carve-outs, less sweep features.
How do they find out about what you're doing? Do you have PR firms? Do you have the website? Do you have salespeople? What's the approach? How do you get the message out who you are?
Pretty tight universe. Everyone seems to know everybody, so I think word of mouth is probably the number one, I would guess. I mean, I'm sure we all do advertising. We have press releases.
Pretty minimal, though.
Yeah.
I think everyone has a website,
everyone
there's
has-
some print media, but it's a fairly small industry in some ways. And I think most people who've launched these platforms, whether it was 9 years ago like we did or more recently like Jonathan and Joe did, a lot of us have been doing this for quite a long time and already have a network of brokers and borrowers.
And portable customers.
Let's talk about pricing. If they went to the bank to get a construction loan for a certain project, they're going to pay LIBOR plus 250 to between 200 to 300.
I mean, that's a recourse deal.
That's a
If
recourse
you want a
deal. That's-
non-recourse,
That's pretty tight.
yeah, from a bank, non-recourse construction loan is going to cost you L425 to L550.
Right, but those are with the
Somewhere in that.
Ozark Centennial type.
I was
of
saying a
thing.
non-recourse. That's a non-recourse construction loan.
Up to 50.
A local lender is going to require recourse of some kind
Right.
in almost all cases.
And what are you going to do?
So, I mean, for us, we're very, very basis driven, but typically our construction loans are somewhere between 60 and 85% of cost, and we're generally between 9% and probably 10.5%. That's generally the range.
Does an 85% loan carry a kicker for you guys?
It depends on basis. You know, again, like there's a deal we're doing now, you know, a marquee kind of a project in Brooklyn where we're the land lender on the water, and we're, you know, sub 1,000 a net foot in a market that's selling for 17, 18, and, you know, so again, it's all about basis for us.
Yeah.
We've done some construction mezzanine and some pre-development mezzanine. We're actually actively now looking at doing senior construction as well. So
And what type of pricing?
the stuff we've done historically has been in the LIBOR 14% area. That's the stuff we're long now, and the stuff we've done most recently in the development or pre-development place. And I think the stuff we're looking at doing is that LIBOR 450 to 500, 60-ish% loan to cost non-recourse.
Sure.
And we are generally 65 to 85% LTC at LIBOR plus 7 to 8, depending on exactly where and exactly what it is.
Senior mezz.
And we'll do the senior and the mezz all the way up. And depending on exactly what the pricing tends to be, we can either hold the whole thing, we may have a syndicate partner, but generally we like to hold.
We have co-living, co-working. Would you lend on that type of deal?
I think you're not going to be in business for long if you're not doing the some of it. But we're if you're talking about like the Regis of the world and the WeWorks, you're talking
I'm talking about the yards, the alleys. I'm not talking, and also the WeWork also, because as somebody said to me recently, you know, it's great to have WeWork in one building, but they open up 3 blocks away.
Yeah,
from
I think I misunderstood. I think you were I thought you had said creative and then kind of
No.
adjusted in my mind. I thought you were talking about creative space. The co-working space is tough. Oftentimes, co-working space is an indicator that more conventional tenant wasn't available. And so I think it's very selective. I do think there's a lot of proximity considerations to take into place. I'm not saying we've never lent on it, but it's definitely something you need to look closely at.
Josh?
It's just about underwriting what it would be if the tenant wasn't there and how much money you have to put in, because a lot of these tenants are asking for huge TI dollars, and you could never replace the kind of economics with, you know, that.
Conventional tenant.
Have you seen it?
No.
Our concern is you have cash flows that you're underwriting at the corporate level, right? Because they either are doing a master lease or own the building or lease a portion of the building, but their underlying income streams are all either daily or weekly or monthly rentals from small entrepreneurs, none of whom are necessarily creditworthy. So we feel like you sort of have a mismatch there that ultimately is kind of hard to underwrite.
Let's not forget that that is a very well-traveled business for many real estate owners and operators throughout New York and everywhere else. The WeWork concept for millennials, it all seems very new and shiny. It's something
around-
that's been around
been
for
around a long
forever,
Been around for
and we'll
years.
see, you know, how it
Plays out.
iterates this time. But I think, you know,
I think a look-through underwriting is really the key to the analysis.
You know, when we're talking about asset classes, one asset class that really hits everybody is the retail. Okay, you know, the turnaround. But there are opportunities in retail also. Would you go to a basically a 50% vacant mall?
I think you're.
I mean, if you're looking at different there was something in the journal today talking about a mall where basically in the Lord and Taylor they put in Ford Motors distribution. Okay, you know, there are opportunities around the country for retail. What about you? Since you're a little riskier.
No, we try and stay away from like binary lending opportunities, and we have been involved in malls in the past and didn't turn out great. It's just, you know, when you lose a Sears, a Macy's co-tenancy, you know, it's just not a great lending opportunity typically for
What
someone
about
like
the
ourselves.
food halls, which are proliferating all the time? Anything about the food halls?
It's about how you underwrite replacing the tenant.
yeah.
Just comes.
Food halls are the same as food courts were in the 80s,
the 80s.
90s, and you know, it's the next iteration of that. I think, the regional mall business is extremely difficult and is creating the majority of the media scare around retail. I think retail is no question going through a generational change in their business, and you have to pick your spots appropriately because of that, and your tenants.
In this similar manner, there are two boroughs that have really opened up recently, the borough of the Bronx and the borough of Staten Island. What's your thoughts about lending in those markets?
I think it's, and I wouldn't categorize those as co-equal. I would put the Bronx, as a deep first. But I think both of those I think has a lot to do with the patience of your capital. I think long term, it's hard to imagine you're going to be any more wrong there than you would have been in Brooklyn long term, right? I mean,
Right.
We're running out of space on the island of Manhattan, and migration outward is a natural thing. I think if you're worried about being right near term, highly liquid, having, being able to pick exactly what time in and out in terms of how your money performs, either as a lender or an equity investor, I think then you're a little more challenged. I think if you have some horizon, it's hard to imagine you'll be wrong.
Josh?
Staten Island, we had bought some distressed deals in 2010, 11, 12 that we did very well on. We took over, we repositioned. We did a deal on the water, an office building that was taken over by a servicer as a lender. So Staten Island in St. George and like the general area around the ferry and around the outlet center is a great place. The rest of Staten Island, a lot of it is suburban, so it's very different from New York City. The Bronx, we've been active as a lender for many years.
We do very little lending in New York, so I wouldn't be able to speak to the boroughs.
I think we think similarly as Josh and Randy. Staten Island is its own animal. It's not like the rest of New York City, and the Bronx is a little bit more ahead of the curve.
New vibrancy in the Bronx, right?
There is. There is.
So, in effect, basically, I think everybody is agreeing that there is plenty of money for real estate. You have to pick your asset, you have to pick your sponsor, and hopefully you'll find the right people. I'd like to thank Josh, Randy, John, Dan, and Jonathan. See you next week.